You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, it was another choppy week for stocks as investors just haven't yet been able to refocus on anything but the U.S. economy. The docket was light on economic reports this week, so investors took comments on economic growth made by Fed Chairman Bernanke on Tuesday as being generally downbeat. Now, while saying that growth has been somewhat slower than expected, he did add that the recovery should resume in the second half of this year. Word on Thursday that the U.S. trade gap narrowed a bit in April possibly provided some additional hope that the recovery may not be as weak as originally thought. The stocks of banks, energy, and airlines were all among those in focus this week. We're happy to be joined again by Steve Reitmeister, our editor-at-large, who happens by these parts from time to time to share his thoughts and experiences with us. And this week you really had an experience, my friend. Steve was invited to the Personal Finance Online Summit hosted and held by the White House and at the White House. And that was quite an experience. You'd never been there before, right?
I had not, or outside of being a visitor, a regular tourist, and so it was kind of neat to be invited to a small, intimate setting. About 25 industry professionals, in the personal finance space, were there to talk to senior administration officials. And what do you know? Out of nowhere pops the president to drop into our meetings, and he spent about 10-15 minutes with us and took a few questions, and so that was a pleasant surprise, and told us that this was an important event, for the White House as well, for him to stop on in because they want to get out their message about what is going on with the economy and what they're doing to improve things.
And that was the whole point of the summit?
Yeah, absolutely. You think of your traditional press conference, and you have the major media outlets, CNN and Fox, and the ABC, NBC, CBS, so on, so forth. But really, and they were very straightforward with us, that our online investment community, we have over 50 million investors who actively take a look for information from us and Morningstar and Yahoo Finance and Minionville, et cetera, and that they get their ideas of what is happening in the economy from us, that really the administration needs to reach out to us to give us access to the leading economic and financial officials in the White House so we understand what they are doing and can share some of that message with others. Now, granted, it's not my job just to take what they're feeding us and just turn it over and say, oh, there it is. Right. We're definitely going to analyze it and put our own subjective opinions on what they're saying, but it's good to have that heightened access to the White House.
Before I get to the president's portion of the summit, there were some other high-level administration people there. Yeah. Did they have anything to throw in?
Yeah, absolutely. I mean, we got led off by Austin Goolsbee, who's, I believe, the head of the economic advisor team for the president. He's the one they always send out on like the Daily Show and things of that nature, because not only is he brilliant, but he's also kind of a funny guy in general. And so he goes, hey, what's everyone getting so worked up about the soft numbers of late? If you take a look at the economic forecast we put out at the beginning of this year, we said that unemployment by year's end would be 9.3%, and we are at 9.1%. We are ahead of schedule on that. That we said 143,000 jobs will be added on average every month, and we're at like 160, 170,000 per month. So yeah, they're volatile numbers. We just got a softer series of numbers, but hey, let's take a look into the big picture here. Things are going in the right direction. I think that was a fair message to put out there.
Kind of like what you've been saying here, right along, the muddle through scenario.
Yeah, and that was the other thing. Now he does believe that the United States can do better than muddle through. He believes that GDP should be 3% plus, but there are soft patches, there are struggles, okay? But also, if he was putting out a message like, hey, the government's not just going to keep throwing in stimulus and working up a bigger deficit bill, just if there's slow growth. We have to, the government did their work to help us all out when there was no business activity taking place. So they dug us out of the hole, but really, if it's just going to be slow growth, they shouldn't spend any more money, and they're only there in case of more dire circumstances, and that was a fair message too.
So then the president walks in, and I understand he offers some advice that his grandmother gave him.
Yeah. I mean, he was asked, if you had something to share with individual investors, what would it be? And he paused for a second and thought about it. And he said, save more, spend less. And that's kind of common wisdom. But the point being is that we have generational problems of people spending beyond their means. And yes, he knew it was hypocritical just to talk about individual investors when the government seems to be doing the same thing. And he certainly didn't miss the opportunity to say we have to work out some of those issues in terms of the deficit. And here we are pressing up against that deficit limit. And so it was good advice for everyone in that room.
All in all, sounds like it was a pretty positive experience. And we're happy that you had the opportunity to have that experience and then come back here and share it with us.
Thank you.
Thanks, Steve. We're going to have more still ahead. Stay with us. Here is your Bull and Bear Stock of the Week. Well, an engine manufacturer and a building product supplier are this week's Bull and Bear of the Week. Stock-wise, Shiraz Mian, Research Director, here with us to tell us why. And we'll start with the bull the way we always do. Cummins is the engine manufacturer. Now, that's a popular name. They've been around for a long time. Cummins.
That's right. It's an Indiana-based company. They have a number of secular trends going in their favor. Number one is this global trend to reduce engine emissions. The other is this need to have fuel efficiency. And the third is this worldwide demand growth, surging demand, in fact, for power and power generators as a result. And Cummins is in the sweet spot for all of these trends.
Because they've got products that are in research and development for each one?
They have the best-in-class products for each of those markets. They are a leading diesel engine manufacturer. They have an exceptional product in the power generation, and they have a worldwide distribution network of distributing these products as well as the components that they make for all of these products. In fact, of all of the industrial names that we follow, Cummins has one of the best internal growth opportunities in the entire market. Just to give you a quick example, they will earn they earned $5.17 last year, will earn $7.87 this year, and next year's EPS is about $9.50. They could make $12 by 2013.
They raised their guidance too.
They beat estimates in the latest quarter, raised guidance, they pay a dividend, exceptional balance sheet. So overall, a very, very good story with the least amount of exposure to this ongoing talk of slowdown, whether temporary or permanent. This is a company that will outshine everybody else.
Okay. The bear of the week, Universal Forest Products Company, they're the building product supplier. Is this a direct reflection of what's going on in the building industry?
You got that. This is basically a play on the housing double dip. We don't want to use the double dip word too much, but it appears that housing, instead of stabilizing, is going back on the downside. And Universal Forest Products, they are more on the lumber side, the wood side. They have about 20-25% of their sales coming from the industrial segment, but pretty much everything else is on the housing side. The biggest is the retail do-it-yourself segment. Right. Then they are in the new home construction end market, and they also have these engineered products or prefabricated products. So a major play on the housing market, and the trend in that direction doesn't look good. We saw that in their latest quarter, where they came short on relative to expectations, and it doesn't look like that we have seen the bottom and the end of that.
They're not alone, though. in that industry.
They are not alone. They have pretty much all of the suppliers to that end market are in trouble, and we are seeing that in estimates and in the outlook for those stocks.
All right, now let's screen for stocks. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. Well, this week we're looking for stocks to short. As far as screening is concerned, Kevin Matris, our top stock screener here, to help us do just that. So on the surface, it seems like a timely article, given that the market is weak right now. But
Right.
Does this strategy then give investors an opportunity to benefit from the market pullback?
Yeah, it does indeed. May was a rough month. June hasn't started off any better. And while I am always looking for stocks to buy, I'm also now looking for opportunities to short as well. Mm-hmm. And real simply, if you believe a stock is overpriced or let's say overvalued, there is a way to make money on it if you believe it's going to go lower. Now, for those people who don't like to short stocks or let's say can't short stocks because they're in a qualified account, you may want to consider buying a put option on these stocks. So that is a fine alternative. But nonetheless, regardless of how you implement it, there is a way to make money as the market is going lower, and that's what we're going to be talking about today.
All right, is this tricky to find these stocks?
It's not tricky, and there aren't any real tricks either per se, and there really doesn't need to be. I think a great place to start is to look for companies that are underperforming in growth rates, and then you also want to try to find companies that are overvalued in regard to their valuation metrics, like a price to sales ratio, PE ratio, and this kind of thing. Mm-hmm. So let me start with the screen, and let's start with a couple of basics. All right? First, I'm looking for companies that are trading over $20 in price. Now, this is just a personal preference. I personally don't like shorting stocks under 20 bucks, but if you're okay with it, adjust the price thing according to your own preferences. But I do want to say that stocks of all prices can go down, and they do all the time. Decide what your preference is.
All stocks are shortable, in other words.
Well, not all stocks are shortable,
okay.
but don't be so afraid just because it's at 9 bucks or 10 bucks or 8 bucks that it can't be shorted. Okay?
All right, got it.
Anyways, average daily volume. For this one, I'm saying 100,000 shares. Again, you want to make sure that there is enough volume so you can get in and out easily. If you were to look at the $20 price and the 100,000 shares, this means that every single stock on this screen has a minimum of $2 million traded on a daily basis. Right. Anyways, let's get to the real stuff.
Yep.
Next one is projected growth rate. I want it to be less than the median for its industry, so it's got growth rates that are below 50% of the rest of the stocks in the peers, okay? Then I want the PE above the median for the industry, so it's trading at valuations above half of the other stocks in its peer group. So that means low growth, high valuations. First off, that's a real good start for companies that look like they could be teetering. Mm-hmm. Then I'm looking for companies with a high debt burden. Debt to equity ratio greater than the median for its industry puts these companies in a situation where they could be more vulnerable. And then I want the percent change in F1 earnings estimates over the last 12 weeks to have been downgraded. So the analysts that are covering them are lowering their earnings expectations for these stocks in the future.
What about stocks that came through the screen?
There was a bunch of stocks that came through. Here's 5. I've got Black Hills Corp, Federated Investors, Foster Wheeler, CarMax, and Northwest Natural Gas. All of these companies look as if they should underperform the market during this correction and probably even beyond that.
Own any?
I don't have any of those right now.
And is this a screen that can be done anytime?
Can be done anytime. Always good to look for short plays, but also make sure that your current longs don't come on the screen either.
All right, we're headed to the round table. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, Fed Chairman Bernanke this week seemingly spooked the market with some fairly innocuous comments that he made on Tuesday about economic growth here in this country, or lack of. We're going to try and get behind those comments and get some interpretation from our editor-at-large, Steve Reitmeister, Research Director Shiraz Mian, and Market Technician Kevin Matris on this edition of the Roundtable, plus top stock picks. Hang around for those. You don't want to miss those. It's the highlight of the entire segment, if you ask me. So, Steve, I'm going to start with you. Was it that what he said was no surprise, or was it that what he said was just nothing good?
Yeah, you know, I'm a little shocked by the immediate reaction, because I think he wasn't saying anything that we hadn't heard or didn't agree with, which is he's saying, you know, the economy is progressing. It's a little softer in spots, or what's the word he used? Uneven, I think was the term he used. Mm-hmm. But, you know, it is progressing. I would take it as don't sweat some of the softer economic readings. A lot of this is transitory. The spike in oil prices and what it means for gas, that's moderating. The Japanese disruptions in production that may have had some effect on the quarterly GDP, those things, that's certainly transitory as well, and so there's no reason to sweat this. And so how that message led to the market putting in a negative finish on the day, I'm not quite sure why.
So then, Shiraz, really, the market read, or investors just read too much into these remarks?
It did. What I agree with all of the take that Steve took from the Fed chief's speech. He did mention that the Fed will keep short-term interest rates and repeated the phrase that they've been putting in that statement repeatedly, the extended period. Mm-hmm. The market interpreted that part of the speech negatively in the sense that if the Fed chief is reassuring us that interest rates will remain low for an extended period of time, and he being the Fed chief, he may be looking at data which is probably even spookier than what we have seen recently.
Interesting point.
That was my take on it, but broadly, he repeated the consensus narrative that the slowdown is temporary, as Steve mentioned, and the second half looks good. And that's probably why the market responded the way it did.
You also brought out in an article that you wrote earlier this week that the economic growth question is no longer strictly restricted to the United States, that it's now a global question as well. So maybe therein lies some of his concern as well.
It is. The U.S. obviously is of immediate concern for the market over here, but we are seeing some soft data out of China as well. Mm-hmm. Car sales have been weakening. The Purchasing Managers Index in China is slowing. There is some softness in manufacturing data as well, though today's trade data in China, particularly the import numbers, were kind of on the positive side. So yes, the growth question is not just U.S. specific. Some of these key emerging markets have also been battling inflationary pressures, tightening their interest rates, and that's kind of slowing down their growth momentum as well.
What did you think about these remarks this week, Kevin?
You know, the reason why I think the market sold off after Bernanke's comments is because, yes, he acknowledged that the economy is growing slower than expected. He lamented over the troubling jobs market. And while it's true he believes that things are going to get better in the second half, I think people are thinking, hey, if he was wrong about the economy growing slower than expected originally, what if he's wrong about things getting better in the second half? And I think the market right now needs to see concrete evidence that the economy truly, truly is gaining some steam. And that's what's happening with the market right now.
So last week you and I spoke about technicals on the program here. Has the technical picture rather changed in your mind at all?
Well, when we spoke, I think we were at 12.3 or 12.4. Now we're flirting with 12,000. If we break 12,000, I think 11.8 is support. Below 11.8, you're looking at 11.5. But if we were to take out 11.5, there's not that much standing between 11.5 and 11,000. I don't think we're going to go that low. I really do believe we're going to find support within a couple of hundred points of where we are right now. You still have a trend line and the 200-day looking very, very supportive. But the market right now is waiting for something good to happen, and that could take some time.
So, Steve, can we expect stocks to track economic news all through the summer?
Oh, yeah. Next week is just chock full of, I'd say, medium weight reports. There's a half dozen reports that have market moving implications. Empire State and Philly, which spooked us last time around. Right. Industrial production, PPI, CPI, obviously jobless claims is certainly high on people's list. And so I'd say the mood is definitely going to move with whatever those reports are telling folks. And so, as Kevin said, People are a little bit concerned about some of the recent data. That's why the market is weak, and they need positive, substantial proof that we are not sliding beyond just a soft patch, and that hopefully there are signs of getting back to stronger levels of growth.
Okay, give us your top stock pick while we're here.
Yeah, with all that being said, I'm basically going to throw in there a 3x short of the Russell 2000 or small cap bear. And that is because I think we have a repeat of last summer. We have softer economic news. We have people, investors, who are perhaps more bearish than the fundamentals indicate. I think that because people do follow the technicals, and they're over time, you always have to test the 200-day moving average at some point, which is about 11,600 of the Dow. That I think there's more downward pressure. And so I just want that in there. It's a little bit of a safety margin. And then I'm going to, once we get to about 11.6, I'm going to flip that puppy around, and I'm going to go 100% long the market because I believe that there is certainly more upside.
All right, Shiraz?
My take is relatively on the defensive side as well. I'm going with Humana, HUM, and Humana has a substantial business in the Medicare and the prescription drug program, and the outlook on those businesses had turned sour after the legislation, the healthcare legislation. But now the market is coming to the realization that it's probably not as bad as it was. It's a good defensive name for these relatively unsettling times.
Okay, I got to move. Kevin?
Mine is unusual. Mine is Essex Property Trust, ticker ESS. They are a real estate investment trust. I like them because they have a steady growth rate, 10 to 12% for the next 2 years out. But what's interesting is that they have been outperforming the market while the market's been going down. The stock and the group has been going up. I think that they have a price target of 150. That's a 10% gain.
All right. And that's all we have time for, unfortunately. Thank you for being with us. Hope the week ahead is a profitable one.